Private equity is a form of investment where funds are pooled from investors to acquire ownership in private companies. Unlike public markets, private equity deals with businesses that are not listed on stock exchanges. This investment strategy allows investors to directly influence the management and operations of the companies they invest in. Private equity firms typically seek to improve the value of these companies before selling them for a profit. The process involves careful selection, hands-on management, and strategic planning. Understanding private equity is crucial for anyone interested in finance, as it plays a significant role in shaping industries and economies. Roots of private equity trace back to the mid-20th century, when investors began seeking alternatives to traditional stock market investments. Early private equity deals focused on buying undervalued companies and turning them around. Over time, the industry evolved, attracting institutional investors and creating specialized firms. Today, private equity is a global phenomenon with billions of dollars invested annually. Its history reflects the changing landscape of finance, innovation, and risk-taking. By understanding its origins, we gain insight into how private equity became a powerful force in modern business. Private equity firms raise capital from investors, such as pension funds, endowments, and wealthy individuals. This capital is used to purchase stakes in private companies. The firms then actively manage these companies, aiming to improve their performance and profitability. Strategies may include restructuring, expanding operations, or introducing new technologies. After a period of growth, the firm sells its stake, ideally at a higher value. This cycle of investment, management, and exit is the core of private equity. It requires expertise, patience, and a willingness to take calculated risks. Private equity encompasses several investment strategies. The most common types include buyouts, venture capital, growth capital, and distressed investments. Buyouts involve acquiring entire companies, often with borrowed funds. Venture capital focuses on early-stage startups with high growth potential. Growth capital targets established businesses seeking expansion. Distressed investments involve rescuing companies facing financial difficulty. Each type has its own risk profile and return expectations. Understanding these categories helps investors choose the right approach for their goals and risk tolerance. Buyout funds are a major segment of private equity. These funds acquire controlling stakes in mature companies, often using leverage. The goal is to improve operations, increase profitability, and eventually sell the company at a premium. Buyout funds typically target businesses with stable cash flows and growth potential. The process involves detailed due diligence, negotiation, and post-acquisition management. Buyout funds have reshaped industries by consolidating companies and driving efficiency. They offer investors the chance to participate in large-scale business transformations. Venture capital is a subset of private equity that focuses on investing in startups and early-stage companies. These businesses often have innovative ideas but lack the resources to grow. Venture capitalists provide funding, mentorship, and strategic guidance. In return, they receive equity stakes and hope for substantial returns if the company succeeds. Venture capital is high risk but can yield high rewards. It has fueled the growth of technology, healthcare, and other dynamic sectors. Many of today's leading companies began with venture capital backing. Growth capital is used to support established companies looking to expand. These businesses may need funds to enter new markets, develop products, or scale operations. Private equity firms provide the necessary capital and expertise. Unlike buyouts, growth capital investments do not require full ownership. The focus is on partnership and collaboration. Growth capital helps companies accelerate their progress and achieve ambitious goals. It is a vital tool for businesses seeking to compete in fast-changing industries. Stressed investments involve acquiring companies facing financial challenges. Private equity firms step in to restructure debt, improve operations, and restore profitability. These investments are risky but can offer significant returns if the turnaround is successful. Distressed investing requires specialized skills in finance, management, and negotiation. It plays a crucial role in saving jobs and preserving value in troubled industry. By reviving struggling companies, private equity contributes to economic stability and growth. Private equity firms must raise capital before making investments. The fundraising process involves pitching to institutional investors, such as pension funds, insurance companies, and endowments. Firms present their track record, investment strategy, and expected returns. Investors evaluate the risks and rewards before committing funds. Successful fundraising is essential for private equity operations. It requires strong relationships, credibility, and clear communication. The process can take months or even years, depending on market conditions and investor confidence. Due diligence is a critical step in private equity investing. Firms thoroughly investigate potential targets, analyzing financial statements, operations, and market position. The goal is to identify risks, opportunities, and hidden issues. Due diligence involves legal, financial, and operational reviews. It helps investors make informed decisions and avoid costly mistakes. This process can be complex and time-consuming, but it is essential for successful investment. Thorough due diligence sets the foundation for value creation and long-term success. Once a target company is identified, private equity firms negotiate the terms of the deal. Deal structuring involves deciding how much equity to acquire, how to finance the purchase, and how to manage the company post-acquisition. Firms may use debt, equity, or a combination of both. The structure affects risk, control, and potential returns. Effective deal structuring requires financial expertise and strategic thinking. It is a key factor in achieving investment objectives and maximizing value. After acquiring a company, private equity firms focus on improving its performance. This may involve changing leadership, streamlining operations, or investing in technology. The goal is to increase profitability and prepare the company for a successful exit. Post-acquisition management is hands-on and requires close collaboration with the company's team. Firms monitor progress, set targets, and provide support. Effective management is essential for achieving desired outcomes and delivering returns to investors. Private equity investments are not permanent. Firms plan exit strategies to realize returns. Common exits include selling the company to another investor, merging with another business, or taking the company public through an IPO. The timing and method of exit depend on market conditions and company performance. Successful exits require careful planning and execution. They mark the culmination of the investment cycle and provide returns to investors. Exit strategies are a defining feature of private equity. Institutional investors play a major role in private equity. These include pension funds, insurance companies, and endowments. They provide large amounts of capital and seek long-term returns. Institutional investors are attracted to private equity for its potential to outperform public markets. Their involvement has helped the industry grow and professionalize. Understanding their role is important for grasping the dynamics of private equity. They influence investment strategies, risk management, and industry standards. Private equity firms are specialized organizations that manage investment funds. They employ teams of experts in finance, management, and operations. These firms identify opportunities, conduct due diligence, and execute deals. Their reputation and track record are crucial for attracting investors. Private equity firms vary in size, focus, and strategy. Some target specific industries, while others pursue a broad range of investment. Their expertise drives value creation and shapes the future of businesses. Management teams of portfolio companies are critical to private equity's success. Firms often work closely with these teams to set goals, implement changes, and monitor progress. Strong leadership can drive growth and improve performance. Private equity firms may bring in new executives or support existing leaders. The relationship between the firm and management is collaborative and focused on achieving results. Effective management is a key driver of value in private equity investment. Private equity is known for its high-risk, high-reward nature. Investments can yield substantial returns, but losses are also possible. Risks include market fluctuations, operational challenges, and regulatory changes. Firms manage risk through careful selection, due diligence, and active management. The reward is the potential for outsized gains compared to traditional investments. Understanding the balance of risk and reward is essential for anyone considering private equity. Private equity operates in a regulated environment. Firms must comply with laws and regulations governing investments, reporting, and operations. Compliance ensures transparency and protects investors. Regulatory bodies monitor the industry to prevent fraud and abuse. Firms invest in compliance teams and systems to meet requirements. Regulation is evolving as the industry grows and becomes more complex. Staying compliant is essential for maintaining credibility and avoiding penalties. Private equity is a global industry with investments spanning continents and sectors. Firms operate in North America, Europe, Asia, and beyond. Globalization has increased opportunities and competition. Cross-border deals require understanding of local markets, regulations, and cultures. Global private equity drives innovation, economic growth, and job creation. It connects investors and businesses worldwide, shaping the future of industry. Private equity has a profound impact on industries. It drives consolidation, innovation, and efficiency. Firms help companies grow, restructure, and adapt to changing markets. Private equity investments can transform entire sectors, from healthcare to technology. The industry's influence extends to employment, competition, and consumer choice. Understanding its impact helps us appreciate the role of private equity in shaping the economy. Private equity differs from public markets in several ways. Investments are made in private companies not listed on stock exchanges. Private equity offers greater control and flexibility but less liquidity. Public markets provide transparency and easy access, while private equity requires long-term commitment. The risk and return profiles are also distinct. Comparing the two helps investors choose the right approach for their goal. Private equity aims to deliver superior returns compared to traditional investments. Returns come from capital gains, dividends, and interest. The performance depends on the firm's expertise, market conditions, and company growth. Private equity returns are often measured over several years. Investors seek high returns but must accept higher risk and lower liquidity. Understanding how returns are generated helps investors evaluate private equity opportunity. Private equity faces numerous challenges. These include intense competition, regulatory changes, and economic uncertainty. Firms must adapt to shifting markets and evolving investor expectations. Managing risk, maintaining performance, and attracting capital are ongoing concerns. The industry is dynamic and requires constant innovation. Overcoming challenges is key to success in private equity. Private equity industry is evolving rapidly. Trends include increased focus on technology, sustainability, and emerging markets. Firms are adopting new strategies and tools to stay competitive. Digital transformation, ESG investing, and globalization are shaping the future. Staying informed about trends helps investors and firms make better decisions. The industry's adaptability is a source of strength and opportunity. Technology is transforming private equity. Firms use data analytics, artificial intelligence, and automation to improve decision-making and operations. Technology enhances due diligence, deal sourcing, and portfolio management. It enables faster, more accurate analysis and helps identify opportunities. Embracing technology is essential for staying competitive in today's market. The industry's digital evolution is creating new possibilities and efficiency. Environmental, social, and governance (ESG) factors are increasingly important in private equity. Firms consider sustainability, ethical practices, and social impact when making investments. ESG integration helps manage risk and enhance value. Investors demand responsible investing and transparency. Private equity firms are adopting ESG frameworks to meet expectations and drive positive change. ESG is shaping the industry's future and reputation. Emerging markets offer new opportunities for private equity. These regions have growing economies, expanding middle classes, and untapped potential. Firms invest in sectors like technology, healthcare, and consumer goods. Emerging markets present unique risks, including political instability and regulatory challenges. Successful investing requires local knowledge and adaptability. Private equity is helping drive development and innovation in these markets. Career in private equity offers exciting opportunities. Professionals work in deal sourcing, due diligence management, and strategy. The industry values analytical skills, creativity, and teamwork. Private equity careers are demanding but rewarding, with potential for high compensation and impact. Many professionals come from backgrounds in finance, consulting, or management. The path to success involves continuous learning and adaptability. Future of private equity is bright and full of possibilities. The industry will continue to evolve, driven by technology, globalization, and changing investor expectations. Firms will focus on innovation, sustainability, and value creation. Private equity will play a key role in shaping economies and industries. Staying ahead requires adaptability, vision, and commitment. The journey of private equity is ongoing, with new challenges and opportunities on the horizon. Private equity is a dynamic and influential industry. It involves investing in private companies, managing risk, and creating value. The process includes fundraising, due diligence, deal structuring, and exit strategies. Private equity drives innovation, growth, and transformation across sectors. Understanding its principles, challenges, and trends is essential for investors and professionals. As the industry evolves, it will continue to shape the future of business and finance. The journey of private equity is one of opportunity, impact, and progress.